If you've second guessed the decision you've made about your investments in the last 4 months, this episode may be for you. We've come up with 5 steps to help you think through the next time you're making a prediction with your investments. Stick around. We've all faced times when we've tried to make predictions with our investments. It might have occurred during the great financial crisis for you. It might have occurred over the last 3 months. We've had a lot of volatility, and that's often when you try to make the most predictions about what you think may happen, and then you make moves in your portfolio because of those predictions. So today we're talking about that overconfidence that we'll sometimes feel in those moments. And we've come up with what we call an R plan. And it's 5 steps that help you in thinking through a thought exercise of how you're making these decisions. So the first one is remembering those feelings that you might have felt at the beginning of this episode that we just went through. The coronavirus pandemic started creeping up and you thought this was going to be really bad economically. I need to sell all my stock. Or you might have made that decision once you started seeing things about flattening the curve and you thought, man, this is really going to be bad. I need to sell out of all my stock, right? But then you're sitting in cash. It continues to fall and you're not exactly sure when. You want to catch that bottom. You're not sure when to buy back in, or maybe you did buy back in and now it's increased again and you're thinking, okay, well, it may have a resurgence in the fall. We don't know how things are going to play out. So maybe I should sell because things are going to get bad and I could get a lower price. These predictions can creep in and cloud our judgment, but it's a bad place to be if you've sold out of your stock and you're not sure how to proceed. So you got to remember these things. That's your first R. Remember those feelings and understand where you are in this moment.
No, that's great, Chad. Yeah, the second one is on the framework we have here is the regret. Many academic research has shown that people feel the pain of loss is twice as much the benefit of gain. And so that regret is, for example, if in March, you just couldn't take the pain of the market declines and you sold. But many don't realize that, from a day-to-day basis, the market can move, 5, 10%. And by selling at the bottom, you potentially miss out on that upside. So you have the regret. And we've seen that the last few months. A lot of people expected the market to go lower. It never did, and they don't have a plan B to how to get back in. So that would be the second R of the framework.
We'll go into more detail in our podcast episode on this, but the third R is resilience. You have to remember the stock market is resilient over time, and you can be too if you stick with an investment strategy. It has averaged about 8 to 10% a year, depending on the indice that you're using to look at. And one of the things that we hear and like to use is generally you'll have a quarter of the time where equity markets decline. But that means 3/4 of the time they're increasing. So it's the decisions that you make during those declines that can harm you longer term.
The declines are temporary and the advances are permanent. So, And then moving down the framework, the fourth R we talked about is review. And this is really reviewing your investment plan. And it's really important to have a plan. We walk through what Financial Symmetry's plan is, what we recommend, some things to think about. Because the reality is, as we always like to say, is the famous Mike Tyson once said, is everyone has a plan until they get punched in the face. You have to understand kind of what you're going to do and how you're going to stick to it, because it's easy to change your mind by listening to the media, friends, family, and not staying to the course.
Yeah, big influences there can really harm you in your decision making through those strategies and take you off course of what you're trying to do for your personal situation. And then our fifth R is the reward. Remember the reward that you get with a long-term investment strategy that the stock market delivers. And the stat I'd like to point out here is that returns generally are strongest after the steepest declines. We pointed out 2 different periods, the last 2 big ones that we went through. The tech bubble, you saw a 36% increase in the 12 months following that decline. And then in the financial crisis, you saw a 72% return in the 12 months following that decline. So those are things that you don't want to miss out on, but it's really hard to stay invested during those times.
Yeah, and that's why stocks provide a higher return than the alternatives, is because you have to deal with that volatility, those ups and downs, and really the downs. And so if you can't, then it's harder to achieve that long-term return.
So when you're thinking through this for yourself, it's good to just have a process to walk through. Take a minute, take a breather, especially when you're feeling rough in these times, because the biggest mistakes happen in the most panic-stricken moments often when you're investing. Serves us well in life sometimes, but not necessarily in investing. So you can check out more episodes we have, other videos we have. You subscribe over here if you like what you heard today and don't want to miss the next episode, or check us out at financialsymmetry.com in the description below. Thanks for joining us.